Mickey Dickey here. And one of the questions I get from more of my younger clients than my older clients, of course, is where can I invest for fast growth? And sometimes that's a misleader because sometimes fast growth can be a detriment. But I found this video from Dave and I wanted to kind of focus on what he's talking about with somebody who called into his show.
Scott's with us. Scott is in Phoenix. Hi, Scott. Welcome to the Ramsey Show.
Merry Christmas, everyone.
Merry Christmas. How can we help?
So I don't do the baby steps. I just been listening to you, and I'm debt free. I just have a mortgage. And my question is that I just came into some money, which is about $30,000, and I want to invest it in retirement because I'm hitting 53 and I really don't have any retirement. I have been paying into my 401k. Every time I get a raise at work, I've been upping my 401. So for 4 years, I'm at right now at $400 a month going into my 401. But I'd like to take that 30,000 and put it into something that would grow quickly and, that I would feel confident about. I don't want to spend it. I don't want to, just go out and blow it. I'm really starting to, hit that age. I'm like, I really do need to think about retirement.
You married?
Yes, I am married. My wife has her retirement through her work, but she's been working on that. She's been at the job for about 15 years, so she's got her retirement established.
Okay. Jump online at RamseySolutions.com and find a SmartVestor Pro in your area. Oh,
Now, that's one of the best pieces of advice I think Dave gives out all the time, and that is find a financial advisor that you feel comfortable with in your area or wherever that you think is going to give you the advice that you're looking for, is actually going to listen to you and help you put together a financial plan that's going to work for you. Now, one of the things that, again, this is a show and I got it, and he doesn't have time to dig deep on these kind of things, but the gentleman's saying he's 53 years old and been investing in his 401k for 4 years, which is, again, not a long period of time. And he says his wife's retirement is handled. When people come and tell me that it's handled, please expand on that. What does handled mean? Okay, they've got $3 million over there, and they're only going to need to live on 300,000. I mean, who knows? But handled is a completely different world for most people. So I'd like to understand what that means. But typically speaking, and knowing my wife, of the female clients that I have with their husbands list, they are far more adept at putting together a financial plan that actually makes sense based upon their income and what they're trying to do. But considering you normally have a household income, what does that mean for the whole thing? So I would rather dig a little bit deeper on that question and that part, but I understand where he's trying to go here and listen to the guy's question.
Open a Roth for this year and a Roth for next year, and do one for your wife as well. So that's 14. That's $28,000.
Okay.
And put it all.
Which, here's the other issue here. He's saying put the 14 in there, which again, what he's saying is opening up a Roth for the gentleman and his wife. He's saying open one for this year and next year. You don't need two. You can just have one, and for the husband and the wife, and then you can fund it for each year. So it doesn't have to be a separate Roth. And I don't know that he explains that in there correctly or at all. But more importantly, since the gentleman's over 50, he can actually put a catch-up provision in there and an extra 3,000. So he can actually put all 30,000 between the husband and the wife's accounts right now, which, again, not necessarily thinking of it there, but and the main reason the Roth is probably the best for this client, which again, I'd have to dig in deeper and understand more of what the client's trying to do. The Roth is, in theory, already paid tax on this money the gentleman has. So by putting it into the Roth, it gets to grow between here and when he's ready to retire without having to pay tax on it ever. So if he puts that 30 grand in there and it goes to being worth 100,000 in 10 years, then you didn't have to pay tax on any of it. That might be the best thing for the client. We don't know. Sometimes annuities might be better. Sometimes a traditional IRA. I mean, who knows? But the other question that needs to be asked here is, can he actually put money into a Roth? And is there are income requirements, and there are other reasons why he may or may not be able to put money into a Roth IRA. So keep that in mind when you're thinking about, if you have this type of a situation. Again, talk to a financial advisor. Make sure you're not messing things up. Also talk to your CPA. to make sure that you're doing things right. Because I've had many, many clients come in here and say, "Hey, I did this or did that," and then my CPA told me I did, screwed it up. It happens. So you need to have a team when we're talking about financial wealth.
All in good growth stock mutual funds across 4 types: growth, growth and income, aggressive growth, and international.
Now, again, I understand where he's going here, and it's relatively broad based, but here's a gentleman who's 53 years old who is wanting to retire relatively, I would assume, in the next 10 years or so. So this isn't a really long horizon, and whether aggressive growth is best for this client or international is best for the client, especially when somebody who says they don't, they want growth, but they don't want to have a lot of risk. So again, I'd be more interested in breaking this down with the client a little bit more. I know Dave loves mutual funds, and I know he's had many, many shows and discussing what types of mutual funds and stuff, because properly managed mutual fund, not just one that's following the S&P 500 or an index. I get it. And one that's run right is a good thing. But just to give you an example, a lot of the mutual funds out there right now, just a regular growth fund, not an aggressive growth fund right now, in the last year is down 30% because it has a lot of NASDAQ exposure to it. So here's a gentleman who's got $30,000. And if last year in March, April, he had told him to do this, he'd be down 30% on something, and aggressive growth is down even more. Granted, the growth in income hopefully wouldn't be down as much, but most growth in income funds are down 22% right now. And international, up until the last month or two, is down even worse. So, there's no fixed income here. There's no, there's diversity. I get it. But one of the things that I differ with Dave is on international. And the reason I differ on international is that most domestic mutual funds that are managed tracking the S&P 500 or something similar to that, the S&P 500, in my opinion, already has international in it. You've got Nike, you have Apple, you have Microsoft. These are international companies, and I know they're not based in Taiwan or Hong Kong or England or whatever. I know they're based here. I get it, but when you have a company like them that are so international, 15-20% of their income is based upon an international flavor, you have the international exposure without actually having to deal with international companies. So I don't know that you have to have an international fund. And when you look at the track record of international funds over the last 20 years, they have not been great. So to me, if I'm going to be aggressive with an aggressive mutual fund, I'd rather balance that with a bond fund. And I know he talks about this in other videos, but that comes into beta. If you have a real aggressive fund and you have something that's not aggressive, like a bond fund, they kind of balance each other out, which in a year like, this particular year, if you had something, normally in a year like this, you wouldn't have a real big downturn in a bond fund, although they did. But anyway, so I'm not necessarily agreeing with his mix here. I do like the diversification. And you don't, sometimes it's not always have to be mutual funds either. Sometimes you can buy individual stocks like an Apple or a Microsoft or an ETF that actually follows the S&P 500, the Dow, or the NASDAQ.
Now, can I add to that?
The following year,
have extra money.
the following year, after 24, after 23, okay. You can in 24. Because I just funded 23 and 24 just then.
Okay. Because I want to be able to, because I have extra money left over since I'm not in debt anymore. I want
you to throw that towards your mortgage.
Okay.
Yeah, I want to.
So again, here he tells the client to take his extra and put it towards the mortgage. Well, what he didn't ask is, how much does he have left on his mortgage? Again, he's 53, so we're kind of getting down to time. But just as an example, let's say this client has 7 years left on his mortgage, and his income is fine, paying off the mortgage a little bit of time. Maybe he has an interest rate that's 2%. Why would you put the extra towards the mortgage and pay it off when it's going to be paid off when you want to retire anyway? Again, I don't know that I agree with the thought process. Again, I want to get rid of debt, but I want to get rid of my debt when my client retires. Before then, it's a little more open. At 53 years old, if he's got some extra cash here and he's done all the things right and all the buckets are checked, so that by the time he is ready to retire, he's going to have the money in all the different buckets. And we talk about buckets later, but basically you've got the money set up so that you can retire when you want to retire and how you want to retire. I'd rather him take some of that money and actually enjoy his life. Break it out, have a vacation, spend a little more time with your kids and grandkids. Again, time is the new wealth. Experiences are more important than object. So let's spend a little bit of time going out, and hey, and maybe they like to camp. Maybe they've got an RV that they want to travel on and go see, the wonders of the world. I actually have a client of mine who is in the process of going and seeing all the different baseball stadiums. Picks 2 a year and goes and gets to see them. So, over time she's going to see all the different baseball stadiums because that's her thing. And that's great. Maybe you have a little bucket list that you can put together of things that you want to go see and travel. Again, I'd rather you diversify, not just in your financial thing, but in your whole wealth picture of not just your financial wealth, but your whole life wealth. Dickey out.